Hey everyone, and welcome to the Love America Hate Taxes podcast. I'm Ryan, and this is Don. And on today's episode, we're going to be discussing what seems to be a hot topic across social media. I see it all over the place. But what kind of entity should I be? Why does it matter? And then how do I set it up properly? So this is a big thing. When I am laying in bed at night and doing my doom scrolling that we do, before we go to bed, it's one of those things where it's like, I see it. It's like, S-Corp, C-Corp, sole proprietor, like there's all these other suggestions out there. So today we're going to dive in a little bit into what each one is and then kind of how which one you should be and how we set it up. So,
And we're going to start with the simplistic and move our way to the complex. So the most common ways when you go start a business. So I'll give a prime example. My wife started a business last year. So when she set it up, it was set as up as sole proprietor. Sole proprietor, of course, it's changed since then, but she set up as a sole proprietor. You fill out a Schedule C, you track your expenses, you track your income, and what's left over, you pay taxes on. Pretty straightforward. But when she set that up, it was temporary because I knew it was temporary. But the reality is, it put us at great risk, meaning that if for some reason my wife was sued for any reason because it's in her name, that can come back into our assets would be at risk.
mm,
So we chose to take the next step, which is what you see on social media, TikTok and YouTube and everything is LLC. What is an LLC? I want to first put a disclaimer out here. We are not giving any type of legal advice. This is strictly on a tax perspective. And I tell my clients this all the time. So you'd want to consult an attorney. I mean, you can go on to not Zoom info. Sorry, legal Zoom.
yeah,
Legal Zoom, yeah.
mm,
And do things like this here. And again, I'm not advising you to go one way or the other, but it's relatively straightforward, and that is the LLC, which is a limited liability company or a limited liability corporation. And that is ultimately you're working the same way. You're running off a Schedule C, a couple different changes there, but it gives you that legal protection as long as you don't violate the rules of an LLC of a corporation, and that is to protect you from someone coming in there and attacking your personal assets.
gotcha. Yeah, because we get a lot of calls, and anytime we ask kind of a corporate structure, I hear just straight up, we're an LLC, okay, but that could be a couple things.
Yep.
You can be an LLC and different entity structures, and so a lot of people don't know really even what they are as far as
Yeah.
that goes. So,
And the reality is what we see most prevalent is the LLC, the limited liability company or corporation. What we hear above and beyond that is an S corporation or a C corp. And I'll
mhm,
dive down here. So there's actually two ways you can have an S corp or a C corp. You can have an LLC and elect to be taxed as an S corporation or a C corporation, or you can go straight in and set up an S corporation, bypass the LLC or a C
mm,
corporation. So pretty, like I said, it's how you want to be taxed. So most people who are starting a business, in most cases, are going to go down sole proprietor or an LLC to start off with, and that's the basic. So when does it make sense to elect to be taxed other than as a Schedule C?
mhm,
Which, let me clarify, Schedule C is you're just paying taxes based upon all the income minus the expenses. You just pay it as ordinary income to yourself. And you pay self-employment tax. So that goes into lead into why you'd like to be an S corporation.
yeah,
So let's say, for example, you have started a business, it's starting to thrive, you're starting to see quite a bit of income come in.
mm,
Let's say it's $100,000 is net that you have.
yeah,
Okay. So you had $300,000 come in, you had $200,000 of expenses, you got $100,000 left over on line 31 of your Schedule C. Then what happens is you're going to pay 15.3% self-employment tax on there. So that's
mhm,
$15,350. Well, the reality is there's a provision in the code that you can take reasonable compensation. So let's say, for illustration's sake, let's say for your activities that you're involved in that business, $50,000 is reasonable comp. Now, I want to put a pause here. There is a proper way to determine reasonable compensation. I would encourage you that if you've never had a reasonable compensation report done, reach out to our office. We subscribe to a service that's put out by the Treasury Department and Department of Labor that provides a report after you go through an interview that is admissible before the IRS to prove it. And I'll expound upon that and why that's important. But let's go back to your example, or my example for you.
yeah,
$100,000, 50,000 is your reasonable compensation.
okay,
All right. So you're still going to recognize $100,000 of income, but you're only going to pay that 15.3% tax on 50% of it, on $50,000.
Yeah.
So you just saved $7,500
Yeah.
just by that one
Yeah.
change.
Change. Yeah.
And so now you're compliant. You're making sure everything does. You still pay tax on the 100,000, but you just saved $7,500, a little bit more than that, $7,650 on your supplement
So,
tax.
is there a dollar number or a ceiling that you wanna change from a sole prop to an S-Corp?
Yeah, there's some different thought process out there. Some say 60, $70,000 is kind of where you'd want to make that transition over there. So if you're making 20 grand a year, there is no point in doing S corporation because, again, what's reasonable compensation on 20 grand?
Gotcha.
So yes, generally when you get about 60, $70,000 is a good time to start giving some serious thought
Mhm.
and absolutely have some conversations on, making sure that you have professional advice on there. But what I was going to talk about is had a client years ago out in California who went through a state audit before he became a client of ours. And what they challenged, and I'll tell you, he had $300,000 of income come in, net income.
Mhm.
He took a $30,000 reasonable compensation. Well, let me say he took $30,000 in W-2 wages, which is not reasonable comp.
Yeah.
And so they'll come in there, and that's a focus, but they came and penalized him on that. He had to pay penalties and interest, and of course the taxes, extra taxes, because it's not reasonable. 30,000 on 300,000.
Did he have a tax planner?
He did not. That's why we got him compliant and did that report. So,
Pay
but
attention.
then I also see it the other way too, Ron.
Yeah.
I gave the example before. This person was taking $250,000 in W-2 income and taking only about 50,000. I'm sorry, it was about $100,000 in K-1. It should have been the other way around.
Yeah.
And so that happens as well. So it's just making sure that you're getting things set up properly. So that's the big thing with S corporations is just how you're being taxed. And then lastly is the C corporation. Um, I personally am not a big fan of C corporations because it's got some gotchas. Meaning number one, let me tell you the reason why you'd want to do one. Let's say, for example, I have a good friend. I just talked to him last week, who has a company that he had built, it grew, and he decided that he wanted to bring investors in. That's when you want to become a C corporation because you have ownership of shares, in that C corporation. That'd be one. Maybe you decide you want to go public someday. You want to grow this thing. Maybe it's a technology company and you're going to take it to the Nasdaq or to the Dow or S&P 500, whatever the case is. But you want to take it public. That would be where a C corporation comes in. So let's say this here that a C corporation is not flexible.
Mm.
Pretty much, you're going to take out as wages, expenses, or you're going to have a profit at the bottom. And that
Mm.
profit at the bottom, you're going to pay tax right now, which is not bad, is 21%. And so let's give an illustration. Let's say $500,000 of income come in and all your expenses came out. You had $100,000 of leftover income.
Mhm.
So you pay tax on it, it's $21,000. All right. So that's good.
Yeah.
But you want to take that 100,000 to yourself. That's a dividend. Now you come over to you personally. Now you're going to pay a dividend tax or capital gains tax. So it's what they call double taxation. That's why generally a C corporation is not advantageous.
Yeah.
That's because of the double taxation. But again, that's generally what I see.
Nice. So, as far as, tax savings, tax strategies, things like that, sole prop compared to a S corp, groups like that, or even a C corp, who has the best opportunity for strategies?
I would say S corp,
Mhm.
hands down. Yeah,
S corp,
yeah.
just a lot more opportunities to implement things.
It's flexible. We talked about the reasonable comp. It's a
Mhm.
lot more flexible from that standpoint. Matter of fact, I have a client that came to us who has a C corporation. We're going to convert them to an S corporation. Now, one thing too, I want to talk a little bit about because we talked about research and development credits in our last episode.
Mm.
Um, that if you lower your reasonable compensation down, it can impact your R&D credits free if it's predominantly on yours. So that's one offset. But the reality is, we've done the research, and it's better to get that
Yeah.
15.3% than it is to do the R&D
Yeah,
credit.
absolutely. That's awesome.
Sorry to get off on that.
You're good, you're good. They need to know that stuff, so that's really good. Alright, so we talked about this before. So, the important thing here is that obviously, your CPA might be recommending a few things. We always recommend find a tax planner, find somebody that's going to be proactive with the approach that can walk you through each one of these steps. But setting it up, making sure it's set up right. What are some common things that you need to do to make sure it's set up right?
So, again, we suggest you get legal advice on here, but there are certain states that are much more advantageous than others. So you got states like Wyoming, Nevada, Delaware, different ones like that that have it's advantageous to have your entity structured there. Now, that does not mean so if I have a Nevada LLC as an example, there's advantages there of having it domiciled there.
Mhm.
But you have to keep in mind there may be some other depending upon what other state, you might have some franchise taxes that come into play because you're operating in their state.
Sure.
But that's number one is making sure that you choose the right state. Um, Filing your formation documents properly. You got to file those, making sure you have your operating agreement in place, and then of course your the documentation the state requires to set that up. And so articles of incorporation, um, EIN number. What I was talking about earlier. So let's say, for example, you're a sole proprietor and you decide to become an LLC. So your sole proprietor is your social security number.
Yep.
When you become an LLC, you need to file for an EIN number, an employer identification number. And again, your CPA, your accountant, your professional can actually get that relatively quick. Of course, you decide whether that's now or later in the future, whether you want to be taxed as an S corporation or a C corporation, or stay as a LLC, which is referred to as a disregarded entity. It just depends on how much income you have coming through there. And then, very, very important, you gotta open a bank account because that bank account legitimizes that entity that you're operating as a business, and that's where you have income flowing in and expenses flowing out, and that's how you and making sure you keep good books. When you become an S corporation, you are officially a business, and you need to operate like a business. LLC is the same way, but S corporation, you wanna make sure you're tracking. Use some software, QuickBooks Online, there's, Xero, some different ones out there,
Mhm.
then one called Wave. But there's lots of things out there, just making sure because what doing good books tells you how you're doing. It's a report card. Nobody like to get a report card when you're in school unless you're a good student. Well, you want to be a good business person. You want to know if you're doing well or you're not doing well. And unless you look at your numbers,
Mhm.
this has been a few years ago, had a doctor up in Virginia and we looked at his P&Ls, which is doing your QuickBooks and stuff. We looked at his profit and loss statement. He said, he said, I'm 52 years old. I've never looked at P&Ls before.
Oh my
And
god.
I'm thinking, how do you run a business?
Yep.
And I mean, you don't know if you're doing good or doing bad,
Yep.
but it's kind of like the old saying is,
Yeah.
a lot of old retirees, they said, listen, if I got money in my checkbook, I'm doing
Yeah,
okay.
doing okay.
Money in my bank account, I'm doing okay. So that's unfortunate. That's not the way you run a business.
Yeah, absolutely. Well, that's great information. Like I said, I just scrolling TikTok, you see it all the time, and it's just what's the truth, with all of that. And so, final closing things, if you're looking at, if you're just now setting it up, you're looking at changing things like that. Make sure again you get a professional tax planner to take a look at that to help you make sure that because it's not just important to set it up, but then also all the benefits and the tax strategies that come with it to make sure you're doing those things right. You really need to have another set of eyes on it to make sure. So, I would definitely tell anybody we do that. Find your local tax planner, things like that as well. Any other closing?
No, I mean, the big thing is owning a business is a great opportunity to reduce your taxes. That's period. So if you're, have a side gig or you're getting full time in some type of business, it's just making sure you set up the right entity structure. A lot of people overpay on taxes because they just not getting good advice or they're just, don't have any advice.
Yeah. Well, guys, we hope you found today's content beneficial. If you like it, like and share on the Facebook, social media, whatever you're watching this on. Share it with a friend, another business owner. And if you have comments, if you have questions, something you want to have us answered, reach out to us via email. We'll be happy to get those answered on another podcast. But until then, thank you for watching.